Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at FIGR Technology Solutions.
And if you find our talks useful, please consider subscribing, give us a like, and drop a comment underneath. It really helps us figure out what stocks you want us to cover next. So getting right into it today, FIGR. This is one of those companies that has been flashing across a lot of screens lately.
Oh, everywhere. It's been incredibly noisy.
Right, but usually with a massive question mark attached to it, because it sits at this really loud intersection of traditional banking and blockchain, which usually means, half the room thinks it's a total scam and the other half thinks it's the future of the world.
That is the perfect way to frame it, actually. Because if you just look at the surface, you see that word blockchain, and you immediately get investors worrying about extreme volatility, crypto winters, lost passwords.
Yeah, the usual headlines.
Exactly. But if you actually dig into the business model, FIGR isn't playing the crypto game at all.
Not even a little bit.
No. It is an infrastructure play. Pure and simple. They are a blockchain-native capital marketplace.
Right, and I think that's a distinction we really need to make immediately for you listening. We aren't talking about a company speculating on the price of some random coin.
Right.
We are talking about a company that is essentially trying to replace the plumbing of the financial system. And frankly, looking at the efficiency metrics, the current plumbing is incredibly rusty.
Rusty is being generous. I mean, the traditional process for securitizing assets, taking a bunch of loans, bundling them up and selling them off to investors, it is ancient.
It's basically a paper mill.
It really is. It involves trust agents, custodians, paying agents, mountains of physical and digital paperwork. It takes days, sometimes weeks to actually settle a trade.
Which is crazy in 2026.
Exactly. So FIGR is essentially coming in and saying, we can do all of that on a blockchain ledger instantly. And by doing that, we can cut out about 100 basis points of cost.
And that 100 basis points, that is the magic number. In the world of high finance, saving 1% on operational friction is the difference between a good year and an absolutely great year.
Huge difference.
But let's double-click on how they actually do this. They have this thing called FIGR Connect, which, it sounds like a social network.
Does sound like a dating app or something.
Yeah, but it's actually a marketplace, right?
Right. Think of FIGR Connect as a digital exchange floor. So on one side, you have the originators. These are the people actually lending money to homeowners or businesses.
Okay.
And on the other side, you have the capital markets. So hedge funds, asset managers, banks, the people who want to buy those loans to get the yield. FIGR Connect is just the engine in the metal that matches them up.
But the key difference here is the blockchain part.
Exactly. Because the loans are native to the blockchain, the record of ownership is absolute. You don't need a third-party lawyer to verify that the loan exists and hasn't been sold twice to someone else.
Because the ledger itself is the proof. The blockchain creates what they call perfect provenance.
Perfect provenance, yeah.
Which effectively automates the trust. You don't need to pay a very expensive custodian to hold the asset because the network is the custodian.
Precisely. And that right there creates a massive economic moat. We talk about switching costs in software companies all the time, right?
Sure, like moving off of a cloud provider. It's a nightmare.
Exactly. Now imagine a bank that has integrated its entire lending workflow into FIGR's rails. They've trained their staff, updated their compliance to handle tokenized assets, and they are suddenly saving millions on overhead.
They're locked in.
They are. Are they really going to switch back to fax machines and 3-day settlement periods?
Not a chance. Once you taste that kind of efficiency, you don't go back to the dark ages. And that stickiness, it's really starting to show up in the cold, hard cash.
The numbers are undeniable at this point.
Yeah, we have the preliminary results for fiscal year 2025, and the top-line numbers are enormous for a company at this stage. We are looking at revenue somewhere between $505 million and $509 million.
It is a massive milestone. Crossing that $500 million mark is usually when a fintech company officially graduates from being an interesting startup to a real institutional player.
Right.
But what stands out to me isn't just the total number for the year, it is the velocity. If you look at the breakdown, the fourth quarter of 2025 alone is expected to bring in between $158 million and $162 million.
Wow. So if you annualize that Q4 number, you are looking at a run rate significantly higher than $500 million.
Exactly.
The growth is accelerating into the end of the year, not slowing down.
It suggests the adoption curve is actively bending upwards. This isn't just linear growth anymore. This looks like the network effects are really kicking in.
The classic marketplace flywheel.
Right. As more capital comes onto the platform, more originators join to get that capital, which brings more assets, which then attracts even more capital.
But let's play devil's advocate for a second here, because revenue is vanity and profit is sanity.
Fair point.
Usually, when I see a blockchain company growing this fast, I just assume they are setting piles of venture capital on fire to acquire those customers. But looking at the efficiency ratios here, that doesn't seem to be the case.
No, and this is the real aha moment for this stock. Look at the return on equity. The normalized ROE is sitting at 21.51%.
Which is huge.
It is. For context, a really well-run traditional bank. Think of a titan like JP Morgan. They're usually thrilled to get an ROE in the mid-teens.
Right, and a typical regional bank is fighting just to get to 10 or 12%.
Exactly. So FIGR is generating almost double the return on equity of a traditional player.
Which completely proves the thesis.
It does. It proves that technology isn't just a marketing gimmick. It is creating genuine operating leverage. They are generating more value per dollar of equity because they just don't have the bloated back-office costs of a legacy institution.
And their return on assets is over 6%, which is almost unheard of in standard banking.
Exactly. The machine works.
Okay, so the machine works. It prints money. But we really have to address the strange financial maneuvering that happened in mid-February 2026.
Yes. The February events.
Because if I'm a retail investor holding this stock, I probably got a little whiplash. On February 18th, they announced a secondary offering, selling 4.7 million shares.
Right.
Which usually means dilution, and dilution usually means the stock tanks. But then, literally at the same time, they announced a $10 million share repurchase program, a buyback.
It was a very complex, very deliberate signal to the market. Let's break it down piece by piece. First, the offering. They issued Series A blockchain common shares at $32 a share.
Okay.
This was entirely about raising a war chest. When you are growing at the speed we just talked about, you need capital to expand the product suite, do some targeted M&A, and scale the tech.
You can't just fund that kind of hypergrowth out of free cash flow.
No, not if you want to capture the market quickly. You need a bigger boat.
So the selling was a fence. They're reloading the cannons.
Correct. But management is smart. They knew the market instinctively hates dilution. So, to counterbalance that fear, they authorized the buyback. This is the board of directors basically saying, yes, we need to raise cash for growth, but we also think our stock is so undervalued right now that we are willing to buy it back ourselves.
It's a bit like a confident homeowner taking out a huge mortgage to build an extension while simultaneously buying up their neighbor's house because it's cheap.
That is a great analogy.
It sends a mixed message initially, but the net result is actually very bullish.
And the market interpreted it correctly. Look at the price action. They priced that massive offering at $32. Where is the stock trading today?
We are hovering right around $34.75.
That is the tell right there. The stock is trading nearly $3 above the dilution price.
Meaning institutional investors looked at that $32 offering and said, we will take all of it.
They gobbled up the supply and just kept buying. If the market viewed this as a desperate cash grab by a struggling company, we would be trading at $28 right now.
So that $32 has essentially become the floor.
It is the absolute line in the sand. Technically speaking, having that much institutional volume clear at a specific price point creates a massive support level. Those big funds will defend that price because that is their cost basis.
Right. And speaking of technicals, we have to talk about the activity on February 19th. Because we saw some very unusual options activity.
We get it.
And whenever I hear unusual options activity, I assume someone knows something I don't. What did we actually see happen there?
We saw a major spike in call buying. Specifically, positioning for volatility or a sharp upside move. This is often what technicians call smart money accumulation.
So not just retail day traders.
No, these aren't retail traders throwing darts on a mobile app.
Yeah.
These are sophisticated players positioning themselves ahead of the final Q4 earnings release. They are betting that the revenue acceleration we talked about earlier is going to really surprise the market to the upside.
But there is a catch with creating this stock right now, isn't there? Because I was looking at the bid-ask spread this morning, and it is wide.
Very wide.
We are talking $37.95 on the bid and $38.04 on the ask in some of the pre-market data. That is not a highly liquid market.
It is not. The volume has been consolidating lately. We've seen days with only 230,000 shares traded, compared to an average of maybe 4 million.
That is quite the drop-off.
Right, and when the spread is that wide and volume dries up, it's like the calm before a storm. Liquidity is incredibly thin, If you are a retail investor, you absolutely do not want to use market orders on a stock behaving like this.
You will just get filled at a terrible price.
Exactly. You need to use limit orders.
That is critical advice. Don't chase the ask, make the market come to you. Now, we have been pretty positive so far. We've talked about efficient tech, great growth, smart capital moves, but we have to look at the dark side.
You do. No company is perfect.
And FIGR has a massive skeleton in the closet from just 2 weeks ago, February 13th, 2026, the data breach.
This is the elephant in the room, and we cannot gloss over it. On February 13th, FIGR confirmed a data breach.
Right. And for a company that sells, I don't know, shoes, a data breach is a bad headache. But for a company that handles financial infrastructure and capital markets,
It is an existential threat.
exactly. The entire value proposition of blockchain is security and trust. If you can't protect the data, that whole perfect provenance argument we talked about earlier starts to look a little shaky.
It does. Now, to be fair to management, they disclosed it proactively. They got ahead of the story, which is what you want to see.
True.
And so far, they have stated there is no material financial impact, meaning no client funds were drained and daily operations didn't suddenly grind to a halt. But the real risk here is reputational.
It's the trust tax.
Right. If a major traditional bank is thinking about moving their $10 billion loan book onto FIGR Connect, and they see a headline about a data breach, they might pause.
They might say, let's wait a quarter or two and see if they actually have this under control.
Exactly. And that hesitation slows down the flywheel. Plus, it invites the regulators. The SEC and state attorneys general absolutely love to investigate fintech data breaches.
Even if nothing comes of it, it just creates noise and massive legal fees.
It does.
And when you combine that specific risk with the current valuation, things get really tricky. We are looking at a PE ratio of over 116x and a price-to-sales ratio of over 23x. That is astronomical.
It is priced for absolute perfection. A 116x multiple means the market expects flawless execution and hypergrowth for years to come.
Which means zero room for error.
Zero. If that data breach causes even a small hiccup in their growth, say revenue grows 40% next quarter instead of 50%, the stock could get hammered.
Yeah.
This is not a sleepy value stock. It is a momentum stock.
And momentum cuts both ways.
Brutally so.
So you are paying a premium ticket price to get on the ride, but the ride currently has some loose bolts. Let's look forward then. What are the catalysts that are going to determine if this stock goes to 50 or back down to 20 in the next few months?
The calendar is packed. First and foremost, late March 2026. The Q4 earnings release.
A moment of truth.
It really is. They guided for that $162 million quarter. They have to hit it.
Actually, given that 116x valuation, they probably need to beat it slightly and raise the guidance for the rest of 2026.
I agree completely. If they come out and say growth is slowing because clients are pausing over the data breach, look out below.
We are also waiting for the final close of that Series A offering in Q1. Once that is done and dusted, the dilution fear is officially off the table for a while.
Correct. But the biggest catalyst, the real macro one, is the regulatory landscape. We are all watching the SEC and FINRA right now.
There is a lot of smoke right now about new guidelines for tokenized securities trading.
This has been the holy grail for years in this space. If the regulators finally give a clear, written green light to blockchain-based trading, it lifts the entire sector.
And FIGR is sitting right there.
If the SEC streamlines the approval process, FIGR is the primary beneficiary. They have the platform built and ready to go. They are literally just waiting for the rules to be written. That is a massive tailwind that just isn't priced in yet.
And what about Wall Street coverage? Because usually a company with $500 million in revenue has analysts from Goldman, Morgan Stanley, and JP Morgan covering it on a daily basis. I am not seeing a lot of that deep coverage here.
And that is the hidden opportunity for retail investors right now. At the moment, most of the ratings on FIGR are quantitative.
So basically just computer algorithms crunching the momentum numbers.
Exactly. We currently lack deep fundamental coverage from the big investment banks. But as they cross this revenue milestone, that will absolutely change.
And when it does?
When a major legacy analyst initiates coverage with a firm buy rating and a $50 price target, that triggers a re-rating of the stock. It brings in the mutual funds and the pension funds that literally aren't allowed to buy stocks without that kind of formal validation.
So you listening are early to the party, essentially, before the big institutional research desks have even set up shop.
Exactly.
Okay, let's wrap this up. We've looked at the plumbing, the financials, the massive risks, and the future outlook. I need a score. On the smart wealth scale, where does FIGR Technology Solutions land today?
This is a tough one. because the operational metrics are stellar, but the valuation and that data breach really worry me. However, I am a firm believer in the macro thesis that banks must become more efficient to survive the next decade.
And FIGR is the tool for that.
It is the best tool for that right now. So balancing all of that, I'm giving it a 7.5 out of 10.
A 7.5, that is a very solid score from you. That puts it firmly in the high conviction category, but definitely with the seatbelt on.
Exactly. Keep the seatbelt fastened. My thesis is that this is a 12 to 18-month hold. This is a multi-year play on the modernization of finance.
But so you are not trading this for a quick 10% pop next Tuesday?
No. You are holding this because you believe that by 2028, the majority of loans will be originated on a blockchain.
And for the listener who agrees with that and wants to open a position, given the volatility and that crazy wide bid-ask spread, where is the entry point?
Patience is your best friend here. Do not chase this stock at $35 or $38. The buy zone is strictly on dips.
Below that $32 level.
Specifically, look for any pullback to that $32 level we discussed. That is where the institutions bought in bulk. That is where the structural support is.
So if earnings cause a temporary dip, or if the broader market gets spooked by a macro headline, use that volatility to your advantage.
Exactly. Use the fear to get in near $32. Set your limit orders and just wait.
Don't FOMO into the green candles.
Precisely. Let the price come to you.
It really brings us back to a fundamental question about the future of money itself. We are so used to the banking system being these huge marble pillars that just never change.
They feel permanent.
Right. But the reality is, banks are just data companies that move value around, and right now they are using 1970s technology to do it. You have to ask yourself, do you believe the future of banking relies on fax machines and a 2-day settlement process, or do you believe it's going to be instant, digital, and verified by code?
If you believe the latter, FIGR is one of the very few pure ways to own that transition. It is not about crypto. It is about better business.
Well said. That is a wrap for today's analysis on FIGR. We really hope this cleared up the confusion between all the coin hype and the actual business reality underneath.
Let us know in the comments. Does that 116x PE ratio completely scare you off, or are you buying into the long-term growth story? We really want to hear your take.
Thanks for joining us, and we will catch you in the next one.
See you next time.